No, right. So we had a line of credit with a bank. It was it expired at the end of January, so we had to get it renewed. But we could have renewed it for a year, 2 years, 3 years. They essentially
Okay.
renewed it for 3 years, which is the full term that we were looking for. Increased its size, so it's 10 million. We have about four drawn on it at the moment. So and the interest rates didn't change, the terms didn't change, so it was a good thing. I mean, again, it was from our perspective, it showed a lot of faith in the business, and so we were super happy to continue the relationship with Wafd, who's our primary lender. So it was a good thing for us. So right now we have about $4 million of debt, which
Okay.
is sufficient given our cash flow. I mean, it's a portion there. It's manageable. If we did some kind of acquisition, maybe some interim financing or something like that, potentially. But at the moment, it's just there. We would prefer to start paying it down. As our production increases, our cash flow has increased substantially with this workover program,
Okay.
which I'm assuming we'll talk about here in a minute. Our
Cool.
we could get up to about 200K a month in generating cash, and so at that point we'd start paying it down. At the bank's prices, which are lower than the current market prices, we had an NPV 10 of $10 million, right? The market cap of the company at the moment is plus or minus 2 million pounds. So you can see
Mhm.
there's a tremendous gap between those two valuations, and part of my responsibility here is to kind of close that gap. I mean, we think there's a lot of value in the share, and we expect that we'll close it at some time. We've kind of we've doubled the value of the company here in the last 6 months. We need to double it again to get people
Yeah.
closer to what we think is a proper valuation of the company. At $75 a barrel, which is what this was run at, we make almost $50 per barrel in profit for each barrel that we generate in Pine Mill. So 48.60 is the number. So the more barrels we can generate, the more revenue we deliver. And if you look, at the end of the phase 2 workover program, we're currently making about $20,000 a month of profit, or 22. At the end of phase 2, we're making 100, right? And
Okay.
then if we
Yeah.
add on Falk 3, then we're up to almost 200K a month, so doubling again. In the case of, we only have one workover that's got about a 14-month payout. All the rest are under a year. And then in the case of the Falk 3 well, the payout of that is 6 months. So, everything is short-term payout with high IRRs. And I think that's what Gervais likes. Gervais likes cash flow. And so those are the things that he's invested in. I think from his perspective, he supported us when we really needed it that first round, also in the second round, and then the share price moved up, and I think he was rewarded for his faith in us, and so he's continued on. So I think he likes a values play, and so I think at the moment we're a value play because our market cap is so disconnected from essentially the NPV of the assets.